This chart illustrates a well-known financial scenario, comparing two hypothetical investors. Ben starts investing $2,000 a year at age 19, but stops entirely at age 26. Arthur waits until he's 27 to start, but continues investing $2,000 every single year until he retires at 65. You might expect Arthur to come out on top. He contributed steadily for nearly 4 decades, while Ben only put in money for 8 years. Yet at age 65, Ben finishes with over $2.2 million, leaving Arthur far behind at roughly $1.5 million. The engine driving Ben's massive lead is compound interest. Financial planners routinely point to this math as a nearly unstoppable method for building wealth. The arithmetic here is precise, but it also relies on a hidden fantasy that distorts how money actually behaves in the real world. This split-screen graph shows us exactly how 2 different growth models operate over time. On the left, we see simple interest. It moves in a straight line because only your original deposit earns money. The growth rate never increases. On the right side of the graph, we see compound interest curving sharply upward. In this model, you earn interest on your initial deposit, and then you earn interest on the interest you've already accumulated. It operates exactly like a snowball rolling down a mountain. As it gathers layers of snow, its surface area expands, allowing it to pick up even more snow at an accelerating rate without any extra push from you. Because of that exponential curve, the amount of time your money spends in the market eventually matters far more than the exact dollar amount you initially deposited. Banks translate this math into 2 specific acronyms, APR and APY, and they apply them strategically based on whether they owe you money or they owe you. When you take out a loan, the bank quotes you an APR, or annual percentage rate. This number represents your borrowing cost, but it usually excludes the effects of compounding, making the loan look cheaper than it actually is. When you open a savings account, banks advertise the APY, the annual percentage yield. This metric includes all compounding effects to show you exactly how much your money will grow over a full year. This multi-line chart shows how the frequency of that compounding impacts your bottom line. 3 identical deposits will yield different results depending on whether the bank calculates the interest yearly, monthly, or daily. The more frequent the calculation, the faster the balance accelerates. This dictates a straightforward rule for consumer banking. Seek the highest APY to maximize your savings, and negotiate the lowest APR to minimize what you pay on debt. Let's bring back that original chart. Ben wins so decisively because of one tiny data point, a guaranteed 12% annual return. If we lower that to an 8% yield, the trajectory shifts. Arthur's steady contributions eventually cross over and overtake Ben's early lead. Then we have to factor in inflation. Over 40 years, the cost of goods and services rises, steadily eroding the actual value of those millions. A high final balance is a nominal illusion. True financial progress is measured by purchasing power, meaning a successful strategy has to outpace inflation, not just print larger numbers. We have physical proof of how these forces interact over long periods. In 1790, Benjamin Franklin left about $4,400 to Boston and Philadelphia, locked in trusts designed to compound for 200 years. Based on his mathematical projections, Franklin calculated that the initial principal would snowball into a staggering $36 million by the bicentennial. When 1990 arrived, the 2 trusts held a combined total of roughly $6.5 million, a fraction of the projection, though still enough to fund civic projects like the Franklin Institute. Franklin's pure math was correct, but the real world introduced friction. Mismanagement, stagnant loan returns, severe market crashes, and centuries of inflation heavily degraded the exponential curve. Starting early gives you an undeniable mathematical advantage, but long-term wealth requires pairing that early start with consistent contributions and anticipating the economic realities that will drag on your returns.